Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will love all of the food stocks we explore on this channel. In this video we will be doing an analysis of Domino's Pizza and seeing if it would be a tasty addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Starting with the 1-year chart, we see that Domino's had a CAGR of about minus 10.3%. Zooming out to the 5-year chart, we see that Domino's had a CAGR of 5.6%. While this may not seem positive, the 1-year return being negative against a 5.6% CAGR over 5 years means that the stock has had a recent pullback, which may be a good entry point for us. Now, let's take a look at the fundamentals. Gross margin is decent at 37%. With Domino's being a fast food restaurant company, inflated cost of goods sold may have been weighing on margins. Revenue has compounded at around 7% over the past 5 years and has hit about $4.6 billion on a trailing 12-month basis. Good revenue growth and an okay gross margin make Domino's a solid food stock so far. Looking at free cash flow, we see a 10.4% CAGR over the last 5 years, while capex has decreased at a CAGR of minus 5.6% and stock-based compensation increased at a 5.8% CAGR. This is what we want to see: growing free cash flow and diminishing capex. Notably, stock-based compensation is growing slower than free cash flow and accounts for only 7% of free cash flow. I am very happy with their cash flow numbers. Beyond great cash flow, Domino's weighted average shares outstanding are decreasing over time at a rate of minus 4.3% CAGR. This means that in addition to growing free cash flow, Domino's is actively buying back shares when the company is undervalued. I love seeing this even more than some kids love cake. Now let's view return on invested capital. Return on invested capital has fallen from 108% in 2018 to 72% most recently. While that trend is negative, the company has been increasing return on invested capital since 2019, which is very positive. Next is cash conversion cycle, a measure of operational efficiency at the company, going from a high of 20 days to end 2022 to 11 days most recently shows that Domino's is improving in that regard. For those who are new to the channel, a negative cash conversion cycle means that a company's inventory is sold before they have to pay suppliers for the materials to make product. Another gold star Domino's. Last, let's explore Domino's debt metrics. We will be looking at the current ratio, the debt to equity ratio, and the net debt to EBITDA ratio as we defined those terms in a recent video. For Domino's, the current ratio is 1.5, the debt to equity ratio is 3.5, and the net debt to EBITDA ratio is 5.9. This shows that Domino's has quite a bit of debt, which adds risk to stock. The fundamentals of Domino's are otherwise strong, though the debt could become an issue if they have to refinance their debt at today's interest rates. Given those risks, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund, and your continued viewership, comments, and likes are a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Domino's. It is a restaurant company with a gross margin of 37%. The 5-year revenue per share CAGR is 15% and the 5-year free cash flow per share CAGR is 13%. The reason why the free cash flow per share growth is greater than the free cash flow growth is that the stock buybacks reduce to the number of shares, which in turn increases the free cash flow per share. As Domino's continues to perform share buybacks, the per share metrics will look even better. A return on invested capital of 72% is ridiculously good and shows just how efficient Domino's is at running their business. Next, the cash conversion cycle of 11 days is good. The only real way to improve this is for Domino's to get paid even earlier when selling its products and wait even longer to pay their suppliers. Channeling more people to buy pizza through their app could help push the cash conversion cycle negative. Concerning debt, a net debt to EBITDA of 5.9 means it would take the company nearly 6 years to pay off their debts with EBITDA. This is a bit too long in my opinion, and I would love to see Domino's pay down some of this debt, especially with their strong cash flow. So aside from its debt position, Domino's is a pretty nice fundamental company. Now let's switch our attention over to valuation. Domino's is slightly overvalued relative to the S&P 500 with a ratio of 1.2. This is a better valuation than many of the companies we have assessed thus far, but it would be ideal to get this company when it is cheaper than the market. The price to earnings growth, or PEG ratio, of 2.1 is not too bad. In sum, Domino's is a strong cash flow generating engine. Its debt is currently a caution area, but I still like the company, especially if they can pay down the debt. This is definitely going on the watch list, and let's see what else is out there. Many thanks for watching. What do you think about Domino's and its debt? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now, and don't forget to put your money where your mouth is.